If you enjoy listening to The Bid, you'll love reading it too. The Bid's monthly newsletter brings together the same sharp insights and big ideas you hear on the show, from the minds shaping markets and investing today. Each edition breaks down what's driving markets and what it could mean for your portfolio in just a few minutes. Subscribe for free at blackrock.com/thebid. The Bid, ideas that move markets. Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Today, we're bringing back our Ask Me Anything format, where I ask one of BlackRock's top strategists the questions you, the listener, want answered. Our guest is Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas in the Investment and Portfolio Solutions team. We'll talk about what's driving global growth, whether markets are finally broadening out beyond the big names, and what investors should make of shifting central bank policies around the world. Gargi will also share what she's hearing most from investors right now and her take on how AI adoption could reshape global equity markets in the years ahead. Gargi, thank you so much for joining us on The Bid.
It's so wonderful to be back.
You are a frequent guest, although we have not spoken to you since April when we were talking about tariff volatility. There's been a lot of changes in the market since then, and we've made some changes on The Bid as well. We've introduced a new format, the Ask Me Anything format, where listeners have submitted questions, and we're going to pose some of those to you and see what you think. I want to start by saying congratulations. I know you just ran another marathon, the New York City Marathon. I think that's your 10th New York City Marathon and your 26th overall. I actually brought in the medal from the 2009 New York City Marathon that I ran. We were comparing the medals from back then and the one you got this weekend. Yours is a lot nicer, but
there's been medal inflation.
Medal inflation. It was much brighter and nicer and bigger. You devote a lot of time to running and you devote a lot of time to market. So what's the connection between the two?
So first of all, it's wonderful to be back. I do like talking about markets and marathon running. So I'll say a couple of things. The first is I run marathons because I have no skill and it does not need skill. All it needs is just putting one foot in front of the other, being disciplined about it, and giving a little bit of yourself every single day. And I think that's the exact same thing if you're an investor in the long term. You don't have to have a tremendous amount of skill, but you do need to dollar cost average in. You do need to spend a little bit of time every day thinking about investments and thinking about markets. So that's one similarity, I'd say. And then the other one, I say this about running, but also about careers in general. In the marathon, Oscar, I'm sure you remember this from when you ran it, you run your own race. You don't think about who is around you, how fast they're running. You just run your own race based on your own time goal and your own training regimen. And I think it's the same with markets. Think about your own outcomes that you're looking for based on your own age or your profile or how much risk you're willing to take. And don't worry about other people's investment habits or where flows are going. Be aware, but think about your own sort of risk parameters. And then the last one, I'm in my 40s now. I've run, as you mentioned, 26 marathons, and the body is so different now than when I first started running in my 20s in terms of how much more I have to do, cross-training, creatine and magnesium, yoga, and all of that to just have similar outcomes. It's the same in markets where portfolios change, volatility change. You constantly have to think about diversification, and the diversification instruments change as well.
I love when we can draw parallels between the markets and then something that you do in day-to-day life. What you mentioned about running your own race. You want to get to the finish line, but people are going to get to that finish line differently. And maybe when we talk about retirement, that feels like a finish line. And again, people take different paths to get there. Let's talk about markets, though. Let's start with monetary policy. There's been a lot of, maybe some people would say, confusion around the Fed this year and the path on rates. Will they cut rates? By how much? When? And we've seen recently that they've cut rates by 25 basis points. We've seen a similar story elsewhere. For example, the Bank of Canada cutting rates. How are you thinking about the rate cut story and what's next in terms of monetary policy?
Sure. So this is obviously something that clients are asking a lot about. There are two things that I think are leading to some of these questions. The first is there is an acceleration, if you will, in the level of growth in the US economy, especially when we think back to the last time we spoke, which was right around Liberation Day, where many were thinking about slowing down in growth, perhaps even a recession. And we're recognizing today that Q2 GDP, as well as expectations of Q3 GDP, if we look at some of the estimates from the Atlanta Fed, for example, they're at the high threes. And at the same time, inflation is coming down pretty significantly, which is very good, as well as job markets are moderating. So all of that is allowing the Fed to cut at a time when growth is pretty solid. Now, what I would say to that is, depending on who you are in the economy, depending on your income level, you might be experiencing quite a different US economy. So rates coming down is actually a good thing for a whole swath of the economy. And we do expect the Fed to continue on the rate cutting cycle. So they've brought rates down to 3.875%. We actually think that they'll cut again, more likely than not, in December. And then they'll cut a little bit more next year as well to bring rates down to that 3%, maybe a little bit below that 3% level. A little bit of volatility was injected because Chair Powell did say that another rate cut in December is not a foregone conclusion. And he said that because obviously there are some pockets of strength as well to contend with, and inflation is still not at target. But I do think we have to keep in mind that as long as inflation is making progress towards their objective of about 2%, as long as we see that labor markets are softening, the Fed does want to be forward-looking. So rate cuts, we think, still to come, and then getting rates down to that 3% or so level.
So rate cuts have begun, and you think there's more to come. And some might point to loosening monetary policy as maybe one of the contributors to a rising stock market. And when we ask our listeners what they want to ask you, one of the things they bring up is the Magnificent Seven, which have continued to dominate market performance. These are the largest companies in the S&P 500. Our listeners are wondering about that concentration and whether they should be concerned about it. When do you think we might start to see a broadening out of the equity market performance? In other words, starting to see the other 493 companies in the S&P starting to contribute more?
Absolutely. So we'll talk a little bit about Mag 7 dominance, if you will. So just looking at the numbers for October itself, Mag 7 and technology stocks were up close to 5%. Meanwhile, a more equally weighted S&P 500 was actually down for the month, reiterating that point that the largest companies that are focused in tech, maybe communication services, are really driving the returns. But before we get too concerned about that concentration, is an acknowledgement that we all need to make around why that is happening. And that is happening because earnings growth is largely in those Mag 7 as well as broad technology names. So we're in the midst of earnings season right now. And what we're finding is actually that earnings season is strong. So even outside of Mag 7, the S&P 493 is actually very strong, about 9% earnings growth right now as of what's been reported in Q3. But Mag 7 is close to about 24%. So for us to continue to think about that broadening out concept, a couple of things have to happen. Number one, we have to see the rest continuing to show earnings growth. And I think we've begun to see that, especially if we compare ourselves to this time last year, where actually the rest of the 493 were not generating positive earnings growth at all. So compared to that, 9% earnings growth for 493 is very solid. But frankly, if the earnings growth and if the capital expenditures, CapEx as we call it, is coming from a majority point, these large hyperscalers, from these large cloud companies, it's really hard to imagine that we can see a broadening out into the small cap parts of the market. So we still think when and if the broadening comes, it'll still very much be within large cap. And we are heartened to see some of the earnings come through this year and in this quarter particularly that is favoring the 493, even though for right now, it is still tech which is leading earnings growth and therefore leading performance.
If you're enjoying this episode of The Bid, help us spread the word. Share it on social media and tag us. We love seeing your takeaways and hearing what resonated with you. It's one of the best ways to help new listeners discover the show. Thanks for being part of the conversation. And now, let's go back to the episode. One thing that comes to mind, we recently spoke to Alex Brazier, your colleague. We asked him whether AI and these Mag 7 companies are in a bubble. He actually said it's more of a mirror, I think was the analogy that he used, that their stock prices are rising, but they're reflecting, hence his use of the term mirror, reflecting the earnings growth that I think you're alluding to. The other thing you mentioned, I think, is that the gap in earnings growth between the Mag 7 and the rest of the market is narrowing. As that gap narrows, though, is when you could see the broadening out of the market. And you mentioned we're in earnings season right now, and these are important periods for the markets during the year where we get a read into the economy and what companies are seeing and how healthy they are. Talk a little bit more about what is your read on companies in terms of what they're telling us so far?
Yeah. And before we actually talk about this earnings season, I want to give a view into what the expectations were, because markets are all about what is expected versus what we get. And coming into Q3 earnings season, after a spectacular Q2 earnings season, the expectation coming in this season was about a 6% earnings growth. Now, this is like me saying I'm going to run a 5-hour marathon. I know that I can probably beat that. So when I run a 4.5, I'm actually kind of happy because my expectations had been lowered. So similarly, going back to the running analogy, maybe I extended it too far, but similarly, the expectations were quite low, so they were easier to beat. Now, as we're sitting today, as we're looking at the numbers come through, about 82% of the companies that have reported have beat their earnings expectation. Both sales as well as revenues are beating, and the beat is higher than they were in the previous few quarters. And then earnings growth is coming in for the entire S&P about 12 to 13%. And again, that is led by a few particular sectors that we talked about. It's certainly led by tech and communication services. We also parse through data, and obviously very easy to do that with some of the AI tools we have now at the firm, but really looking at what are some of the trends that are coming through? So obviously one big one is around that capital expenditure, the CapEx season, as we joke that it has become. How much of the hyperscalers, these large cloud companies, are doing CapEx? So that's been something that, again, has surprised to the upside from the large 5 or so hyperscalers. CapEx is greater than what was expected, even at the start of earnings season in the end of September. The second thing that we watched is to what extent was that CapEx that has been already done resulting in revenues. And again, one of the numbers a colleague shared was the 10 biggest spenders. They have $2.5 trillion in revenue, $600 billion in cash, and they have zero net debt. Now, those are some very powerful dynamics that are taking place. But away from hyperscalers and CapEx and tech, I also think there are a couple of other things that we need to focus on. The first one is just the consumer trends. There's certainly premium shoppers that are spending on purchases like iPhones or travel. And then we're seeing value seekers that are looking as well to other parts of the market and perhaps some other names that aren't doing as well because of who is shopping there. So that's becoming quite evident in earnings season. And then the other one, GLP-1s are obviously a big theme of earnings season. And some of those drug producers had some incredible quarters related to the continued adoption of GLP-1. So those are some other themes that we're looking through. And then maybe I'll leave you with one last one, which is just around tariffs. Obviously, very top of mind for consumers as well as corporations. And it's been interesting to see that some of the tariffs are coming through, or some of the tariff concerns are coming through in certain parts of tech, semiconductors specifically.
Gargi, we've talked about the markets. Now, one of the unique lenses that you have on the world is being able to see where investors are putting money to work and looking at the flows. I know it's something that you monitor very closely. So where are people putting money to work? And what does that tell you about investor sentiment and what people are interested in?
Yeah, I'll talk a little bit about where people are putting money to work, but I'll also talk a little bit about something that we've been doing, which is just polling our clients. We have client calls every month that are focused on some event that's taking place. And what we tend to do is look at what our clients are telling us around their sentiment on markets. And one thing that's clear is clients are becoming more bullish today in November than they were perhaps even in September. And another one that came through in our latest polling data, which I'm very proud to say, is that about 60% of US wealth advisors that we polled actually think of AI as a really strong opportunity. And that's obviously something that we're going to focus on because that is where the earnings growth is. So we've already, now coming back to flows, we've already seen, especially in October, this is one of the strongest months for inflows, with ETF flows actually having topped 1 trillion. That's a huge step, especially by October. And what's particularly fabulous is it's not just coming from any one part of the market. So that represents record fixed income flows. That shows a lot of investors moving to equities, especially growth equities, and also things like commodities. Investors are moving to asset classes like gold. And obviously, we've spoken about gold before, but having flows coming through these different asset classes to lead us to this 1 trillion level, I think is really, really interesting to watch. And again, clients are continuing to tell us in the polling information that they think AI is an opportunity and they actually want to step away from cash. So historically, people have been more allocated to cash than before because cash rates were, of course, above 5%. Now, with cash rates moving lower and the expectations for cash rates to continue to move lower, we are seeing investors poll that they are stepping out of cash and they're looking to go to other parts of the market. We also look at advisor portfolios. We look at how advisors are positioned. We look at the data there. And what we're finding is despite this optimism around AI that is evident, many advisors still haven't actually allocated to that trade. So there is still an under-allocation to that tech trade, and there's an over-allocation to that small cap trade. So that's something that has been interesting to watch.
Great observations. And it sounds like people putting money to work across different asset classes. And you call out AI as a theme, which we've described as a mega force, one of these structural themes that we think will persist for many years. But you're saying that maybe people are still under-allocated to that theme. Gargi, we've polled our listeners to see what questions were on their mind, and we've asked you some of those, but you're out meeting with clients and speaking at events all around the world all the time. What's the most common question you're getting in those forums?
Sure. So maybe I'll focus on two here. The first is, and this has come about more recently in the last month or so, is just around, is AI in a bubble? And I think we do need to address that. And I know you mentioned that you'd had another podcast on this already. But some of those questions are coming up given some of the deal news that has come through, and people are questioning this circularity of the different names that are investing in each other. And I just want to point out that depending on what valuations you are looking at, we don't necessarily believe that the price to earnings is the only valuation metrics that one should look at. But even if you were to look at that, yes, absolutely, those are elevated. But then again, if you look at valuations adjusted for earnings growth, so what we call the PEG ratio, if you will, that is nowhere near the levels that it was perhaps back in the late 90s, which is kind of a period that a lot of clients have asked us about. So look, we're obviously always going to be watchful. We are looking to see these hyperscaler CapEx numbers. We see that being funded out of cash flow, which we think is a good sign. We also think that there's going to be, call it another maybe 3 trillion in cumulative AI CapEx between now and 2028. And again, to the extent that that is something that's going to be revenue generative, could be very solid for the AI story. But obviously, if there are smaller companies that are doing a lot of CapEx that is not funded from cash flow, that is funded from debt, that's something to be aware of. So that's a question that's coming up. And then maybe the other one that has come up again in the last month with the volatility in gold prices and with the unreliable correlation of stocks and bonds, investors have been asking us around how should we think about the role of gold in a portfolio and how should we think about the role of bonds in a portfolio. And specifically with the Fed beginning to cut rates, we've continued to talk about how we think earning income right now, especially sort of in that 3 to 7 year part of the curve, that continues to be so attractive. So that's something that clients are asking us a lot about with respect to the role of bonds, and as well as what is the role of gold, which we won't go into because I know we have a whole other podcast on that.
You have come and talked about gold. In the past, you wore your gold bangles. You don't have them on today, but Gargi, it's a lot of fun to ask you anything because we can talk to you about markets. We can talk to you about running as well.
And gold bangles.
Congratulations again on finishing another New York City marathon. You have proven to be very resilient, hopefully like the portfolios that you're helping people build. Gargi, thanks for joining us on The Bid and sharing your intel. We hope to have you back at some point soon.
Thank you for having me, Oscar.
Thanks for listening to this episode of The Bid. Next week, we'll be taking a look at the opportunities in Europe and what markets need for a broad resurgence. Don't forget to subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.